Welcome to the Explainer! Today we're embarking on a pretty fascinating journey into the massive, intensely complex world of global shipping. Think about it for a second. When you buy a new product, watch a skyscraper go up, or, even just eat your breakfast, you are interacting with a global supply chain that relies almost entirely on massive vessels crossing our oceans. So in this Explainer, we're going to make sense of this colossal industry. We'll start with a super wide-angle view of global macroeconomics and then systematically journey all the way down to the specific financial health and corporate strategy of a major player in this space, Safe Bulkers, specifically looking at their Q1 2026 position. Honestly, it's a perfect masterclass in how massive global trends dictate ground-level corporate realities.
Okay, let's dive into this agenda. We're going to start with the big picture in Part 1, the global macroeconomic canvas, before zooming in on Part 2, maritime supply and demand. In Part 3, we'll look at a massive wildcard, the Strait of Hormuz choke point. Then in Part 4, we'll explore Safe Bulkers' strategic expansion before wrapping the whole thing up with Part 5, financial health and shareholder returns.
But before we get lost in spreadsheets and data, let's anchor this in physical reality. Look at this absolutely incredible vessel. This is the MV Efrosani, a Kamsarmax vessel delivered to Safe Bulkers back in April 2025. When we talk about supply, demand, and capital deployment today, remember that we are literally talking about these colossal, floating feats of engineering, moving thousands of tons of critical cargo across completely unforgiving oceans. This is the tangible, heavy metal reality of global trade.
Part 1. The Global Macroeconomic Canvas.
So to understand the ships, you really have to understand the economies they serve, right? Maritime shipping is entirely dependent on the heartbeat of global economic health. Basically, if the world is building and consuming, ships are moving. According to the IMF's base scenario for 2026, we're looking at a sustained momentum of global economic recovery, with overall global GDP expected to hit 3.1%. But the real story here is where that growth is actually coming from. India is absolutely charging ahead with a massive 6.5% expected growth, and China remains a total powerhouse at 4.4%. Meanwhile, advanced economies are hovering around that 1.8% mark. So this tells us that the center of gravity for industrial demand, and therefore shipping, remains firmly in the east.
And how does that GDP growth translate into physical materials? Well, steel demand is actually a perfect proxy for this. Notice how shifting economic output directly fuels raw material needs. Interestingly, for 2026, we see China's steel demand actually contracting slightly, by about 1.5%. But, and this is key, the rest of the world is aggressively picking up the slack with a 2.5% increase, and that's projected to jump to over 5% in 2027. So the cargo is still absolutely moving, but the destination ports, they might be shifting.
Of course, it's not all smooth sailing out there. The macroeconomic canvas definitely has some dark clouds. Global trade is facing some very real downside risks right now. There's elevated policy uncertainty globally, inflation is proving to be pretty sticky, and ongoing trade tensions between the US and China are a constant variable in the background. Additionally, China's property sector crisis continues to be a drag on their domestic demand, even while their exports remain strong. As observers, we're just here to look at the data, but it is incredibly clear that these geopolitical and economic headwinds act as a very real, tangible friction on global trade.
Part 2. Maritime supply and demand.
So we have a moderately growing global economy that's hungry for raw materials. Now let's transition from that broad global economy down into the specific mechanics of the dry bulk shipping industry itself. Who actually has the ships to move these goods? Well, we are currently looking at a classic supply squeeze, and this brilliantly illustrates the problem. Across the globe, 60% of the dry bulk fleet is over 10 years old. Now, in car years, a decade might not sound terrible, but in harsh, relentless saltwater, these ships are aging out fast. Normally, you'd see shipyards rushing to build replacements, but because of intense capacity constraints and long lead times, the global order book is incredibly low. It's sitting at just about 13% of current capacity. So, to put that in perspective, we have a rapidly aging global fleet and a tiny, tiny pipeline of new ships coming in to replace them.
Now, this industry-wide supply squeeze is exactly where Safe Bulkers' strategy really shines. While the global fleet averages 12.5 years old, Safe Bulkers maintains a noticeably younger fleet, averaging 10.5 years. Plus, 80% of their fleet is Japanese-built. In the maritime industry, Japanese shipyards are renowned for premium quality and long-term reliability, and Safe Bulkers sits at 80% compared to a global average of just 40%. They have deliberately positioned a younger, highly premium fleet precisely at a time when the broader market is getting old and constrained.
Part 3. The Strait of Hormuz Choke Points.
But, as we all know, even the absolute best fleet positioning can be totally upended by geography. All of these carefully modeled supply and demand forecasts we just looked at, they can be completely disrupted by a single geographical wildcard. According to BIMCO's forecast scenarios for 2026, the status of the Strait of Hormuz dramatically alters the entire global shipping equation. If the strait is closed, supply growth is choked down to barely 0.5 to 1.5%, with demand growth stifled at about 1%. Why? Because roughly 1% of the entire dry fleet capacity gets physically trapped in the Persian Gulf and established trade routes fracture. But if the strait remains open, supply can grow up to 2.5% and global cargo demand expands to a much healthier 3%. It is a massive, massive squeeze depending entirely on one stretch of water.
To really ground that abstract choke point data into real-world impact, just look at how it swings the demand for actual commodities. If the strait closes, global grain demand growth basically collapses from 4.5% down to just 0.5%. Minor bulk cargo completely reverses, going from a booming 7% growth if the strait is open to a 1% contraction if it's closed. This perfectly highlights how geopolitical stability directly dictates the literal volume of food and building materials moving across our planet.
Let's move to and see how this builds. Part 4. Safe Bulkers Strategic Expansion.
Knowing these macroeconomic risks and knowing the serious supply constraints of the industry, how is Safe Bulkers actually maneuvering through these troubled waters corporately? Well, one major move is their strategic dual listing on both the New York Stock Exchange and Euronext Athens. By dual listing, they are actively broadening their shareholder base. They're expanding their pool of institutional and retail investors, offering European markets direct access to a premium blue-chip maritime corporation that is governed by strict NYSE standards. It's a really smart move to reinforce their long-term strategic positioning and tap into diverse capital markets.
But as any business owner knows, raising capital is only part of the equation. It's how you actually spend it that matters. Their fleet modernization strategy is aggressive and incredibly forward-looking. They currently have 11 new builds on order. And importantly, this includes 2 dual-fuel methane ships, signaling a really clear preparation for the shipping industry's massive fuel transition. Furthermore, they boast 0 vessels in the lowest CIE rating. Now, CII is an international carbon intensity metric, so basically they are future-proofing their massive physical assets against impending environmental regulations.
Part 5. Financial Health and Shareholder Returns.
So, we've seen the macro environment, their specific fleet strategy, and their corporate maneuvers. Let's bring this explainer home by looking at the hard numbers, starting with a foundational metric for any asset-heavy business, liquidity. Examining the specific corporate health metrics of Safe Bulkers in Q1 2026, they are sitting on a staggering $374.4 million in total liquidity and capital resources, with a consolidated leverage of just 34%. In a world full of macroeconomic headwinds and all that geopolitical uncertainty we talked about, this massive liquidity milestone really emphasizes the company's financial resilience. They've built the war chest required to navigate disruptions or, just as importantly, seize market opportunities.
So the crucial point is, how does this resilience directly benefit the investor? Well, through consistency. They have paid 18 consecutive quarterly common dividends. That's $95.1 million paid out since 2022, functioning alongside their aggressive share repurchase programs. It's a clear, undeniable demonstration of generating sustainable returns for their shareholders across all sorts of market fluctuations.
To understand exactly how they are generating this kind of cash, we need to briefly define a key shipping finance acronym, the TCE rate, or Time Charter Equivalent. If you're not in the shipping industry, don't worry. Just think of this simply as their net daily earnings per ship. It is the revenue a ship makes per day, after you strip out the varying costs of specific voyages and commissions. It basically allows us to see the true apples-to-apples earning power of the fleet on a daily basis.
And when we look at that daily earning power year over year, the story is incredibly strong. Between Q1 2025 and Q1 2026, their TCE rate, their daily earnings, jumped significantly from $14,655 up to $17,095. But at the exact same time, their daily operating expenses, or OPEX, actually fell from $5,765 down to $5,223. This is the dream scenario for any operator, right? The company is successfully increasing its daily earnings while simultaneously shrinking what it actually costs to run those ships every single day.
Now, what's really interesting about this slide is how this widening gap between higher earnings and lower costs translates directly to the bottom line. Net revenues jumped from $64.3 million up to $74.4 million, and adjusted EBITDA, which is a core measure of operational profitability, saw a massive jump from $29.4 million up to $40.7 million. By having a modern, efficient fleet in a supply-constrained market, they are maximizing their profitability beautifully.
Which brings us to the end of our explainer and honestly leaves us with a pretty critical question to ponder. We've seen how Safe Bulkers is successfully navigating the current waters through young fleets and very strict financial discipline. But stepping back and looking at the macro data again, how will the growing fragility of shifting global choke points, combined with an aging global fleet that simply isn't being replaced fast enough, redefine the true cost of global trade in the coming decade? These ships might be out of sight for most of us, but their impact on our everyday global economy is about to become more visible than ever. Thank you so much for joining me for this explainer. Keep learning, and I'll catch you next time.